Stock futures pointing higher this morning. That's following Friday's rally, although our next guest says a recession and a meaningful decline in earnings is in the offing, thus suggesting a significant drop is in the cards for the market this year. Here to discuss, we've got Matt Maley, who is the Miller Tabak Chief Market Strategist. Matt, great to speak with you as always. All right, so help break down the outlook for the rest of the year. I mean, we're beginning week 2 of the year now, so where should we expect there to be perhaps some divergence in the market? Where will things kind of continue to mirror over from 2022 even?
Yeah, I think, Brad, that we have a problem here with so you guys were just talking about the retail situation with some of these retailers reporting some negative or outlooks on Macy's and even Lululemon, where they say, well, Jesus, just our margins, our demand's fine. Well, the demand's fine because they're lowering prices, and the demand isn't fine, I guess is my point. So they've had to lower prices. That's got demand back up. You hear what I'm saying? Is that the consumer, I think, is very much constrained. We see it with record levels of credit card debt. We see it with the savings rate back on levels we saw back in the financial crisis, and so the consumers becoming constrained, and they're 70% of our economy. So I think as we move into the new year, we're going to see these earnings forecasts come down, and with a stock market that's still, even though it's come down a lot, is still on the more expensive side of history. That's going to mean it's got to fall further.
Now, Matt, you're certainly not the only person who's saying that earnings are not going to be great, right, going into this reporting season, which really kicks off in earnest on Friday with the banks. So why hasn't it been priced in enough? If this is a hot topic, right, that earnings are going to be lousy, is it just that people don't realize just how lousy they're going to be?
I think that has a lot to do with it, Julie. I mean, it's fun. You get a little nervous when you're in the middle of the consensus. I mean, a year ago at this time, when I turned quite bearish on the stock market, there weren't that many people that were saying the same thing. Now, a lot of people are saying what I've really been saying for 6 months now, that earnings would turn down. But we also have to realize too is that these companies, at the end of the year, when they come out of their third quarter earnings reports, they don't want to give bad news at the end of the year, and they tend not to lower their prospects. But as they go into a new year, the CEOs, they like to lower the bar, and so that by the end of the year they can say they exceeded it. And so I think you're going to see a little bit more honesty, I don't know what to say, a little bit more forthright comments about their own prospects. And we're seeing that with the Macy's and some other companies recently. And of course, these layoffs, they're going to start having an impact as well. I mean, I guess my biggest point is that, the Fed started raising rates last March. It's usually about a 6 to 9 month lag. We're starting to feel the impacts of that in the economy. And at some point soon, I think people are going to come to the full realization that their earnings are going to have to come down.
Matt, you write a lot about all-time cryptos and Bitcoin. Bitcoin's been rocking the past 6 days. I'm looking at Coinbase, Riot Blockchain up nicely here in the pre-market. Is it time to get involved in here, even though the FTX fallout continues?
Well, it's difficult because it's not just FTX. Of course, we've had all these other companies that keep falling by the wayside, or at least making some big announcements, whether it be in the one of the cryptocurrencies specifically, or one of the companies, whether it be an exchange or the lenders, et cetera. That's going to cause some problem. And I'm surprised that Bitcoin is and these other cryptocurrencies have held up as well as they have. So that is a bullish situation, and hopefully that means that we are coming to kind of at least the most of the bear market in the cryptos are behind us. The problem is, how much upside does it have? I just think with all this negative news out there, the real reason we saw a nice big pop at the end of the bull market was that the bull market for cryptocurrencies, that is, was because the institutions were getting involved. With all this news that's out there and still coming out there, and all the regulations we think are coming, I think it's going to be a while before Bitcoin takes off again like it did in the past. So it has many times in the past. So can you dip your toe back into it? That might be fine, but I'm not backing up the truck here. I just think there's just too many uncertainties, and we're not going to see that big movement by the institutional investor anytime soon.
Matt, separately within your notes, I was reading through what you called still too much focus on inflation, not enough focus on recession. It feels like we've been talking about a recession for the past year now, but the reality of when that hits and how shallow or how mild that becomes, that certainly has also been worth the discussion as well. From your purview, what type of focus should we continuing to be placing on recession that we haven't already?
Well, I mean, I think that the people have been kind of talking about it, but again, we're not pricing it in. When people, well, I can put it this way: every single recession we've had since World War II, the stock market has gone to at least 15 times earnings. We're still at 17 times earnings. Now, to get to 15 times earnings, we got to drop down to about 3,500 on the S&P 500, and that's assuming we don't see our earnings come down at all. If the earnings stay at where they are right now, but if they drop to the 200 level on the S&P 500 or even lower, obviously that means the market will have to move lower to price in that recession. My point is, we can talk about it all the time, but I think so many investors are saying we're going to go, instead of going pricing in a recession, they're pricing into what we're going to do is we're just going to go back to what we had for the last 12, 14 years with all this Fed, largesse, with all the QE and zero interest rates. I just don't think we're going to get that. If the Fed pauses, it's not going to be a pivot. They're not going to take interest rates way down to zero, and we're not going to have QE. Therefore, we're not going to have 17 to 20 or 22 times earnings. We just can't have that unless we're getting ever-increasing amounts of liquidity. As liquidity comes down, that means valuations have to come down. I think the market has to come down. It doesn't mean I'm calling for the end of the world or a repeat of 2008. I just think we have to be a little bit more realistic.